Welcome to Mark's Spreadsheet version 25 and newer. Mark's Spreadsheet is a sophisticated Microsoft Excel spreadsheet designed to help Canadians run retirement projections. Although the spreadsheet is sophisticated, entering your data is relatively straightforward. The spreadsheet is designed to be usable by anyone who is comfortable enough with their finances to do their own taxes. The spreadsheet runs on Microsoft Excel 2010 and newer on PC and Mac with macros enabled, and can be downloaded from marksspreadsheet.com. Navigating retirement requires a goal and a plan. Examples of goals include ensuring you have enough cash to live your desired retirement lifestyle, giving to your children or charity while you're still alive or through your estate, spending your last dollar on the day you die, or some combination of these. Creating a plan to reach your goal involves making a number of decisions. How much you need to save for retirement while still working, when to retire, how much you need or want to spend when retired, how to draw down your investment accounts, and when to start your pensions, including CPP and OAS. All of these decisions have financial and tax implications. The choices you make can take you closer to or further from your retirement goal. Mark's spreadsheet is designed to help you make these decisions while minimizing taxes and maximizing the funds available to you in retirement or to your estate. Using financial data that you enter, the spreadsheet runs projections for the next 50 years, showing the long-term effect of your decisions. Before we get into data entry, let's have a look at the dashboard worksheet where you will run your projections. A projection includes income, expenses, taxes, and account activity for the next 50 years. The projection summary boils your projection down to a projection status and key numbers from the end of the final year of your projection. This will be the earlier of 50 years from now, or when the last spouse is projected to die, whichever comes first. Underneath the projection summary are the basic optimizers. Optimizers help you make financial decisions. We will see how optimizers work later in the tutorial. On the left, the plan section contains information about your retirement choices. Make changes in this section, and the effect of your choices are immediately shown in the projection summary and on the charts. The charts show all years of your projection at once. There's a lot going on in the Cashflow Chart, but understanding it is key to know where money is coming from, where it goes, and how excess cash is invested to optimize your estate. We will cover the Cashflow Chart later in the tutorial. Click on the Help button in the top right corner to access a description on our website. Account and debt balances show how your account balances and debt change over time. This chart will show how your accounts are drawn down and your debt paid off, and if you go into debt at any point in your projection. For those not familiar with the term, net worth is what you own less what you owe. This chart shows projected net worth for each person. Since the principal residence is shared between spouses, and often a large component of net worth, it is shown separately on the chart. Net estate value is what is left after you die. It assumes all assets are sold, all debts and taxes are paid, and life insurance is paid out. When a single person or the last surviving spouse dies, any remaining amount in an RRSP or RIF is typically taxed at the highest rate, about 50%. One strategy for managing this tax liability is to draw down your RRSP or RIF accounts earlier in retirement. Mark's spreadsheet can help with these projections. The following are instructions for enabling macros in Microsoft 365 running on Windows 11. If your configuration is different, there may be a different way to enable macros. Check our website for details. Once you have downloaded the latest version of Mark's spreadsheet to your computer, move the file from your Downloads folder to a folder of your choice and rename the file if desired. Right-click on the file and select Properties. At the bottom of the General tab, there is an Unblock checkbox. Make sure it is checked and click the OK button. This will release the security restrictions on the file so it can be used. I'm now going to show you how to enter your own data into Mark's spreadsheet. This is what a fresh download of the spreadsheet looks like after you have unblocked Microsoft's security restrictions. This is the Start Here worksheet. Check the top of this worksheet for any error messages. In this case, the spreadsheet is telling us that we must enable macros. Macros are a Microsoft Excel programming feature and must be enabled for the optimizers to run and for the spreadsheet to work correctly. Enabling macros is done differently for each version of Excel. Go to the link provided to learn how to enable macros for your version of Excel. Depending on how you enable macros, you may need to do this each time you open the spreadsheet. In the case for Microsoft 365 on Windows, you get a security warning up top. Simply click the Enable Content button. You may also need to click Yes in a dialog to make the spreadsheet a trusted document. You will notice that once I have done that, the warning message disappears. Blue Help buttons are available throughout the spreadsheet. Click on any of them to open our website to learn more about the relevant topic. Under Instructions, click on Step 1 to activate the Data Entry worksheet. The Data Entry worksheet contains 2 white columns, one for each person in a couple. If you are a single person, leave the second column blank. Replace any default data with your own. This is important. The spreadsheet distinguishes between blank cells with nothing in them and cells containing zeros. Read and carefully follow the instructions at the right side of each row. Rather than repeating the descriptions for each cell in this video, I will describe only the key cells. Starting in the Personal Info section, enter each person's name in the name cells. This identifies the person on other worksheets within the spreadsheet. For a single person, make sure the second name is left blank. Complete the remaining cells in the Personal Info section. Enter dates in the format specified. Note that one advantage of Mark's spreadsheet as opposed to an online service is that your data remains totally private and under your control. Moving on to the Employment Income section. Enter annual amounts for your salary and deductions. It is not necessary to enter CPP and EI deductions, as the spreadsheet calculates them automatically. Exclude any employer group RRSP contributions from your salary and add them in this cell. Moving on to pension income. The spreadsheet supports both CPP and QPP for Quebec. If you are already receiving CPP or QPP, enter the monthly amount here and the age you started. Otherwise, leave the cells blank and fill out the next section. In your My Service Canada account or the equivalent Quebec account, you can click on the links provided. The government will give you an estimate of your monthly CPP or QPP benefit at a given age, typically age 65. This amount is in current year dollars. Enter the amount and age they give you here. If you don't have access to your My Service Canada account and want to make a rough estimate, Google maximum and average CPP or QPP benefit for the current year and make an estimate for your own situation. A caution: if you intend to retire before age 65 and don't have sufficient dropout years to cover until age 65, the Service Canada estimates may be too high. In that case, you may want to use a pension consulting service to get a better estimate. There are a lot of fields to cater to the various varieties of defined benefit pension plans. If you are fortunate enough to have a DB pension plan, follow the instructions carefully and enter your values here. You can also use these fields to enter an annuity, which is essentially the same thing. Moving on to income tax. The spreadsheet needs to know some information from your previous year's tax return so it can calculate future taxes correctly. These amounts can be found on your tax return or your notice of assessment from the CRA. If you have not filed your taxes for the previous year yet, estimates are sufficient. To be conservative, you can leave all the carry forward amounts blank. Moving on to accounts. Enter the balances for your various accounts at the beginning of the year. If you have joint accounts, you can split the balance between spouses. If you have multiple accounts, add them together. You are also asked to provide information about the expected returns from each of the accounts. The spreadsheet uses these percentages to run projections over the next 50 years, so they should be representative of the long term. Use wisely and conservatively. Some firms provide their own estimates of long-term returns for each type of investment. A link from the Institute of Financial Planning is provided for your reference. Your non-registered accounts require a bit more information so that taxes can be calculated properly. Enter your non-registered investment account balances. ACB stands for Adjusted Cost Base, also called book value, and can be found on your investment statements. Knowing the ACB allows the spreadsheet to calculate capital gains when investments are sold. Enter the total ACB for each account. The next 4 rows relate to returns. It is helpful to think of your non-registered account as a single investment that generates capital gains, Canadian eligible dividends, foreign dividends, and interest. Percentages you specify apply to the account balance as a whole, as opposed to specific investments within the account. For example, if your non-registered account has a total balance of $100,000 at the beginning of the year, and you're expecting $2,000 in capital appreciation and $3,000 in Canadian eligible dividends, you would specify a capital appreciation rate of 2% and a Canadian eligible dividend rate of 3%. The same applies to foreign dividends and the interest rate. Confirm that the total return for your account is a reasonable number. The overdraft account is used when there are not sufficient funds available to meet expenses and you go into debt. When an overdraft is present, the spreadsheet charges interest. Use larger percentages here, up to 25%, if you want to discourage the optimizers from acquiring debt. Follow the instructions in the consumer debt section if you have debt. The spreadsheet will use excess funds to pay off these debts in the order that you specify. Under principal residence, enter an estimate of the market value of your home if you were to sell it today. Also, enter the amount of any outstanding mortgage. Mortgage payments are specified in the dashboard's plan section. You can also enter information for income generating properties like rentals that you own and non-income generating properties like cottages in the other real estate section. Follow the instructions. Under life insurance, enter the current cash value and death benefit for any individually held and jointly held life insurance policies. The cash value is the amount you would receive if you surrender the policy prior to death. For some policies, the cash value and death benefit change over time. This is supported by the spreadsheet, but is an advanced feature and is beyond the scope of this tutorial. click Step 2 to activate the dashboard. I have preloaded data for a couple that is still working and plans to retire at age 65. We've seen an overview of the dashboard earlier in this tutorial, but now I will describe the fields where you enter your retirement decisions. Hover over any cell with a red indicator for a description of that field. Under the Plan section, you can see the age each person turns this year. In this case, Jack will turn 51 and Jill will turn 50. Enter the planned retirement age for each person in these cells. The spreadsheet assumes that the person retires at the end of the month when their birthday occurs. So in this case, Jack would retire at the end of the month when he turns 65. If you want to do succession planning, you can enter an age at death. The spreadsheet assumes the person passes away at the end of that calendar year. In this example, if we want to check if Jill will be cared for if Jack passed away at age 80, we can enter 80 in Jack's age at death. And the charts update accordingly. Notice that because of good tax planning, all of Jack's net worth passes to Jill when he dies. In this scenario, the only future income that's lost is Jack's OAS, and Jack's CPP is replaced by a lesser CPP survivor benefit. From the charts, it looks like Jill will be cared for financially. If you want to do planning for a typical lifespan, let's say 85 years, and you want to optimize the estate you leave at age 85, you can enter that age at death for both spouses. Notice that the final year in the projection summary and the charts update accordingly, stopping when the last spouse turns 85. The horizontal axes of the charts show the ages of both spouses, and then when Jack passes away, only Jill's age is shown. You can change from ages to years by using the drop-down in the Basic Optimizers section. Retirement, death, and downsizing of your principal residence and or budget are called life events and are shown as small black rectangles on the charts. You can see that the retirement age for each person is indicated, as well as the projected death of each person. We're going to plan for longevity for Jack and Jill, so I'm going to take out the ages at death, and the spreadsheet will run the projection out 50 years. That will take us to the year 2075, when Jack will turn 101 and Jill will turn 100. Under the budget section, enter your annual budget. This is your annual spending excluding charitable donations, taxes, mortgage payments, and RRSP contributions. Simply hover over the title to be reminded of what is included and not included. The spreadsheet increases this amount by inflation every year, and it's shown by the blue bars on the negative side of the cash flow chart. Charitable donations are specified as a percentage amount on top of your annual budget. So in this case, with an annual budget of $65,000, charitable donations of 10% equals $6,500. Your emergency fund is specified as a number of months of expenses. Expenses include your annual budget, charitable donations, taxes, mortgage payments, and RRSP contributions. In this particular case, Jack and Jill have chosen to keep 6 months of their expenses in an emergency fund. The total amount is shown on the right, and the spreadsheet attempts to keep this amount, adjusted annually, in your savings accounts. The spreadsheet needs an estimate for inflation. The percentage you specify here should be representative of expected inflation over the next 50 years. It is hard to estimate these numbers, but that is the nature of retirement planning. The Bank of Canada aims to keep the inflation rate close to 2%, with varying success. We will use 3% as an example. You can experiment with different inflation rates to see how your projection responds. Now we need some additional information about your principal residence. In the following sections, because it is easier to budget and estimate in current year dollars, amounts are entered in current year dollars, even though they will be paid or collected in the future. The spreadsheet uses the inflation rate you specify above to convert your entries to future year dollars. The spreadsheet allows for 2 downsize events. Downsizing can involve your principal residence and/or your budget. Often, retirees will downsize from a family home to something smaller, either owned or rented, and then do a second downsize later in life as they need additional care. Enter the year or years that the downsize occurs. For example, 2040 and 2060. If you're planning to buy again, enter the amount that you're planning to spend on a new residence in current year dollars, or leave empty to downsize only your budget. In this particular case, Jack and Jill's plan is to downsize in the year 2040, spend $500,000 in today's dollars on a new residence. This will be a smaller property with fewer expenses, so they have estimated that their new annual budget will be $50,000 in today's dollars. For the second downsize in the year 2060, Jack and Jill are not planning to buy another residence, likely because they're moving into care or perhaps into a rental apartment, so they have set the purchase amount to $0. In that case, they'll have care or rent payments that will increase their budget. They've estimated $95,000 in current year dollars as their new budget. Enter estimates for your own situation or leave the years blank. For the purposes of this demo, I'm going to assume that Jack and Jill want to remain in their current home, so I'm going to clear the downsize years. In the mortgage section, enter your annual mortgage rate interest, number of payments per year, and the payment amount, and the spreadsheet will calculate your mortgage payments for you. The spreadsheet also allows you to enter a reverse mortgage. A reverse mortgage may be used if you plan to remain in your home. With a reverse mortgage, you can receive a one-time and/or series of payments. You are not required to repay the mortgage until you sell your home or pass away, whichever happens first. Be aware that interest rates on reverse mortgages are typically higher than conventional mortgages. Both spouses must be 55 plus to obtain a reverse mortgage, and the payments may not exceed 55% of the value of your home. If you are planning to use the optimizers, you can skip the pensions, registered retirement funds, and tax strategies, as the optimizers will find the best values for you. Otherwise, you can enter values and watch the projection summary and the charts update in real time. One of the strengths of Mark's spreadsheet is that you can try a decision and see the effect of that decision right away. For example, Jack has the option of taking CPP at any age between 60 and 70. First, let's note Jack and Jill's net estate value of $5.5 million. Net estate value is what is left after you die. It assumes that both spouses have passed away, all assets are sold, all debt and final taxes are paid, and any life insurance is collected. Now let's try starting Jack's CPP at age 60 and see what happens. Notice that the net estate value went from $5.5 million down to $4.9 million. So this may not be a good decision for Jack if he's planning to live to age 101. Similarly, if we enter 70, we can see that the net estate value goes up to over $5.8 million. A better decision if Jack plans to live to age 101. Note that the projection summary can be shown in future, in this case the year 2075 dollars, or current 2025 dollars by changing the pop-up. Current dollars are also called net present value. We're going to stay in future year dollars for the purpose of this demo. Let's go back to Jack's typical age for CPP, 65. Note that Jack and Jill's current plan is to take both CPP and OAS at age 65. This is the typical retirement age. Also note that Jack and Jill's current plan is not to make any further contributions to their RRSPs and to only withdraw the required minimums from their RIF accounts once they retire. Step 3 is the optimizers. Under their current plan, Jack and Jill's net estate value is projected to be $5.5 million in 2075. Let's see if the optimizers can help us improve that. Click Estate. Estate optimizes RRSP contributions and withdrawals and the ages at which CPP and OAS are started in an attempt to maximize your estate in the final year. That's a lot of variables, and it would take you a long time on your own to fiddle with all of them to find a good solution. However, the optimizer can do that for us. Note that the optimizer is trying different values for both our RRSP contributions and withdrawals, and is also trying different pension ages for CPP and OAS. It's searching for promising candidates that maximize Jack and Jill's estate, and then it will try to refine those candidates. Let's let the optimizer run to completion. The estate optimizer finished in just under a minute. The time is dependent on your computing hardware, how many other programs you have running, and if you keep the spreadsheet in the foreground while it is calculating. In that minute, it projected Jack and Jill's income and expenses, taxes, and account activity for the next 50 years, and did that about 300 times with different options looking to maximize net estate value. Notice that the optimizer has filled in the suggested retirement fund contributions and withdrawals and strategies for those, and increased the CPP and OAS starting ages to 70. The best news of all is that these changes have increased Jack and Jill's estate in the year 2075 from $5.5 million to over $7.4 million, an increase of 35%. Pretty impressive. The basic optimizers make typical choices for the user and combine the advanced optimizers to achieve the desired result. Beginners should stick with the basic optimizers until they become familiar with how the optimizers work. Estate maximizes the amount you can give to your children or to charity when you die. Retirement ages determines how early you can retire. budget maximizes your annual budget, and donations determines how much you can give to charitable causes during your lifetime. Test shows how much your projection is overfunded or underfunded in year one. By default, the retirement ages, budget, and donations optimizers try to take your account balances to zero in the final year. If you want to leave some funds in your accounts, you can set the amount in the account balances target. This works if you are working in future or current year dollars. For a more detailed description of all the optimizers, refer to the website. Let's take a closer look at the cash flow chart. This chart is key to understanding how your retirement is funded and how excess cash is invested to optimize your estate. Sources of cash are shown as positive values and include employment and pension income, account withdrawals, tax refunds, and other income that you specify. Uses of cash are shown as negative values and include your budget, charitable donations, tax installments and payments, loan payments, account deposits, and other expenses that you specify. In any given year, sources of cash and uses of cash must equal one another. The red lines on the positive and negative sides of the chart show your total expenses. Expenses include your budget, charitable donations, taxes, and loan payments. Any amount on the positive side that exceeds your expenses is excess cash. Amounts on the negative side, exceeding your expenses, show how that excess cash is deposited into your accounts. In the case of Jack and Jill's projection, for a number of years early in their retirement, the spreadsheet has withdrawn from their non-registered and RRSP accounts to make TFSA contributions in order to reduce future taxes. The spreadsheet deposits excess cash as follows. First, to satisfy your RRSP contribution strategy. Second, to repay any overdraft. Third, into savings until your emergency fund is full. Then into your TFSA up to your contribution limit. And then any remainder goes into your non-registered investment account. In the event that your retirement withdrawal strategy does not withdraw enough cash to meet expenses, and there are insufficient funds in your other accounts to cover the balance, the spreadsheet will withdraw from an overdraft account. This will result in interest being charged until the overdraft is repaid. Activity in the overdraft account is shown as red bars on the chart. Jack and Jill's current projection is showing as funded. That means with the assumptions they have entered, their projection has enough funds to make it to the final year. Watch what happens when I increase Jack and Jill's annual budget to $80,000. The projection summary now shows that they are house poor. This means that they own their own home, but they have gone into debt to live there. See the red bars on the charts, indicating that their overdraft account has been used. Jack and Jill should consider downsizing or taking out a reverse mortgage to access the equity in their home so they don't go into debt. When I increase Jack and Jill's annual budget to $90,000, the projection summary shows that their plan is underfunded. Downsizing their home or taking a reverse mortgage is not sufficient in this case. Jack and Jill will need to reduce their annual budget or work longer to make up the deficit. Before we wrap up this tutorial, I would like to introduce the Snapshot Worksheet. Click on Step 4 or the Snapshot tab to access this worksheet. While the dashboard gives an overview of all years of your projection, the snapshot provides detail for a single year. Simply enter the desired year, say 2035, and the snapshot will update with that year's numbers. Income and expenses, cash flow, account activity, and changes in net worth and net estate value are provided. If you change your projection by changing an entry in the dashboard's plan section, the snapshot will update accordingly. Now for a dose of reality. 50 years is a long time. Think back 50 years to 1975 and what things were like when the average house price was $30,000. Inflation has a huge effect on prices. Interest rates and investment returns have varied considerably. We've had a number of financial crises, and there have been substantial changes to the tax code. I also bet that your personal circumstances have changed significantly, but the fact you are here means you adapted along the way. All this to say that the longer the projection runs, the more uncertainty there is. It is a good idea to rerun your projection each year with the latest spreadsheet and to maintain enough flexibility in your plan so that you can easily adapt to changing circumstances. This ends the video. Be sure to visit our website for more information and subscribe to our mailing list to be notified of new developments with Mark's Spreadsheet.